My name is Alison Grieve and I'm founder and CEO of G-Hold. We manufacture ergonomic patented holders for tablet computers and also for mobile phones more recently. So we invested in a piece of machinery a few years ago to increase our profitability, to also increase our manufacturing capacity, and also to ensure that we were able to retain our manufacturing in Scotland. The key value of G-Hold that separates us from our competitors is that we allow the fingers to be very, very close together and the hand in a relaxed position when people are using our holders. And so in order to achieve that level of comfort and to allow the fingers to be close together, we have to make sure that our parts feel good against the fingers. So let me just explain how production works and the cost structure associated with that supply chain. So we own the tools that make the parts. However, they are housed at an injection molding factory in Lone Head. They then process those parts and we're charged a per unit cost. The more we order in one order, the cheaper that cost becomes. Some of the parts need to be processed in a particular way to achieve that comfort that I mentioned before. This part is the part that fits between the fingers. So it goes through what's called a vibratory finishing machine, a kind of tumbling process whereby any kind of rough parts of plastic are removed, and it means that we're able to achieve that key value of comfort in our products. They then arrive with us in a central location whereby we have a freelance contract assembly team who put all the different product parts together and put it in packaging, and then we ship out to our customers around the world. Prior to 2017, the tumbling machine was housed with a contract manufacturer down in England. So these units would be shipped all the way to England, they would then be tumbled, and then they would come back to us in batches. This mattered to us because it created a bottleneck in production whereby we didn't have the parts as quickly as we would like them, which meant we couldn't assemble the full set of parts, which meant that we couldn't ship to customers until we had done that. There was a longer lead time, of course, because they had to be shipped to England and then come back to Scotland. There was a higher cost per unit because we didn't own the tools that enabled us to tumble the parts. And there was reduced capacity because we could only fulfill so many orders within a particular period of time. This was particularly important for one of our customers, the Home Shopping Network, because they required large volumes of products to be fulfilled in a very short period of time. The Home Shopping Network is a giant retailer over in the US that sells all of their products on television programs, so you literally cannot miss a deadline for production. This also meant that when we were fulfilling orders for them with our limited capacity, it meant that we had to turn away orders from other valuable customers, and this is why we had to make it a priority. Okay, so here comes the numbers. Now, these are going to be made up numbers in case you're spies for our competitors. However, the methodology by which we made the decision about whether to invest in that machine and bring it to Scotland to use here remains exactly the same. With an initial upfront investment of £30,000, we could purchase the tumbling machine and bring it to Scotland. Prior to that, the cost of the processing, the tumbling of the units with the contract manufacturers in England was £300 per cycle or per batch. Now you could fit 650 units into a cycle. So per cycle and per 650 units, it was £300. Now, the contract manufacturers would save up 10 batches, so 10 times 650 units, so 6,500 units, and then they would ship them in one go. And the cost of shipping in one go was an additional £50. So in other words, to tumble 6,500 units was a total of £3,000 plus £50 for the shipping back to us. We realised that by purchasing the tumbling machine for £30,000 and taking it to our Scottish manufacturing facility, that we were able to reduce the cost of tumbling per unit to 20 pence per unit. So our calculation needed to be how many units would we need to sell in order to justify that upfront investment in cost reduction alone. Another calculation that we needed to make was how many orders were we turning away by not being able to turn them around fast enough at our busy time of year. So we added that into our assumptions when we looked at turnover for the next 3 years, based on historical data of which customers we'd kind of had to let down before Christmas and when HSM was ordering just so many units. So we worked that into our turnover figure alongside our increase in profitability, and we made a side-by-side comparison with carrying on with contract manufacturing or bringing the machine to Scotland. I'll finish by saying that there is a big difference between profitability and cash flow. So when we're forecasting, we'll always look at a P&L forecast, so how profitable will our products be as they move along the supply chain, but also we need to know when are we going to pay our suppliers? So that's our cost. When's it going to leave our bank account? And when are we going to be paid by customers? And that careful balancing act of cash flow is just so incredibly important for a small company, because if you make a mistake with cash flow and you overcommit to your cash, then you're not going to be able to keep going, regardless of how profitable your products might be on paper.